Welcome back, everyone. Michael here with Offshore Citizen. Today we're going to dive into a little subject which is kind of little understood, but actually a great tool. I've talked a little bit about it in a very particular context in the past, but it's useful because very often one of the problems that comes about when you're doing structuring is you can reduce the corporate tax rate, but when you take money personally, you end up taxable on it. And so this is something that you can do first of all, from the perspective of asset protection, in terms of just protecting yourself for the future as a possible investment, etc. But it's also useful potentially for getting money out of a company in a tax-advantaged way, or at least getting to use that money in a tax-advantaged way. So we're going to discuss today the subject of permanent insurance. What is it? How does it work? Why should you care? And I'll explain a little bit later how that benefits you in terms of personal tax level, so stick around for that. Before we get started, if you have not done so already, please click the subscribe button. They tell me you should smash the subscribe button, destroy it, obliterate it, whatever it is. These are apparently the terms that I am not familiar with, but yeah, that's what they say. Click the notification bell. Hopefully, if you like this video at the end, please click the like button. And if you'd like to get in touch with me for any sort of international structuring, tax planning, asset protection, banking, residencies, citizenships, payment processing, etc., you can book a call, creditor.fm/Michael Rosmer, link below, or check out our websites, offshorecitizen.net, offshorecapitalist.com. Let's get started. Okay, so in the world of insurance, there's a whole range of insurances that you can get. Obviously, you can have vehicle insurance, property insurance, rental insurance, director's insurance, etc., etc., etc. We're going to talk today what is principally life insurance. Okay, we're going to talk about what we call permanent insurance. Okay, and this is in contrast between kind of like term insurance. Okay, now I'm using the example of life insurance. There are a couple other cases where you can have other types of permanent insurance. Okay, so it's not all life insurance, but I'm going to use it because it's the most common example. And increasingly, there's a situation where if you want to set up and maintain banks in a lot of bank accounts in a lot of places, it helps if you have some other products from the bank, and one of those products that you can get is insurance policies. They like this a lot. They're going to keep you around more because you're a more valuable client, because this is a valuable product to them. Okay, the premiums that they collect tend to be quite high, and so that's the case. Now I have some clients who will kind of complain. They're like, oh, they view it as like they've lost the money, but actually, it's not a bad thing to have for a portion of your wealth. I've done some videos in the past on the infinite banking system, which utilizes a form of permanent insurance, typically dividend participating whole life insurance. But in this particular case, we're going to talk more broadly than that. So normally, what people are used to, the idea of insurance, is that, hey, listen, I pay a fee. Maybe it's a one-time fee, such as for a warranty, right? Or maybe it's a monthly fee or an annual fee. And if something goes wrong, it pays out, okay? This is a form of temporary insurance, meaning that if something doesn't go wrong, it doesn't pay out, I lost the money, okay? This is how term life insurance works, okay? So you have maybe, these policies are usually very cheap, right? I first got one when I was maybe around 25. I think I was spending like $25 a month on it for a $250,000 policy, something like that. And, basically I got that because if anything happened to me, my mom, whoever, would be able to have that money to take care of what was associated. You may get it on your kids. Again, you may have it for yourself, for your kids, so that, if something happens to you, your kids are taken care of. Basically, you're buying a lotto ticket, right? Now, I think this, as well as house insurance, as well, anytime the loss would be unrecoverable, or at least extremely difficult to recover, you can't afford it, is probably worthwhile. My idea is that if you can afford it, you should always self-insure, meaning that you should, just pay it. So one of my policies, for example, when buying cars, is only buy cars that you can afford to pay for in cash and also replace in cash. So, and the reason for this is that way you don't have to carry collision insurance on it. Again, I'm abstracting this because it depends where you are in the world, what the insurance rules are. But basically, they make money off you when you buy insurance. So if you can self-insure, that's better. You're going to end up ahead versus if you don't self-insure. Now, permanent insurance is a little bit different, okay? Permanent insurance has two components. It has the temporary insurance that you're used to, in this case, like the term life portion, which has a death benefit, of course, and it has an investment product attached, okay? So let's say that I used the example before of the $25 a month, okay? Maybe in this case, you're paying not $25 a month, you're paying $250 a month, okay? So 25 of that is still going to pay for your death benefit, okay? The other part is going into an investment, okay? It's being invested for you. And that investment, now there's the most common types, there's a variety of other hybrids, but the most common two types are universal life and whole life, okay? Basically the difference between these is whole life is contractually guaranteed in something that the insurance company is managing, right? So they have their portfolio of bonds and stocks. Usually this is regulated, so there's some way to do it. Warren Buffett used to buy insurance companies so that he could manage that money more effectively and create a return for himself. Universal life, you have more control on it, so you can say, okay, I want to put it into this mutual fund or that. In practice, these are usually kind of horrible investments because the MER, the fees that are associated with it, tend to get doubled up. So you pay the fees on the mutual fund, plus you pay a fee on the insurance on top of that, and it's not really that great. So some people really advocate, they say, hey, listen, universal life is so much better than whole life. I think the exact opposite is true, and we can have a whole debate around that subject. But I would generally say the argument is, some people will say, hey, buy term and invest the difference, as opposed to buying whole or universal life. I think that that's a fair argument for universal. I think it's less fair for whole, and here's why. So all that's really happening is that money is going into some sort of an investment. And that investment, typically, if you're doing whole life anyway, has a contractually guaranteed portion, meaning that you know exactly what it will be worth 5, 10, 15, 20, 25, 50 years from now, okay? Because it's contractually guaranteed, okay? They're saying, hey, listen, that amount is usually low. Then you may also have a portion which is what's called paid up additions, is the dividend participating portion, if you have a dividend. So basically this is, hey, depending on how well their investments are doing, you get an additional bonus on that, okay? Over a long period of time, the historic numbers, and a number that I think is pretty reasonable to be targeting, is that should pay you 5 to 5.5% in growth, okay? Now, this is going to get into some stuff about why 5.5% growth or 5% growth or whatever actually is not as bad as it sounds on the surface. To me, that sounds really bad. I'm like, my target is like 20+%, and I would settle with maybe 10. So this falls below that. So I'm like, well, hang on, why would I do this? Well, there's a variety of reasons why. So what happens normally, again, is your premiums are going away for that. If you die, you have this death benefit, okay? So when we're talking about this cost of insurance, that includes the cost of the death benefit, all right? Meaning that if something happens to you, your loved ones, your beneficiary, whoever it is, they're gonna get paid out. And that's gonna typically, in most cases, bypass any sort of probate, bypass any sort of taxes, etc. And so that money is protected for them. So that's a very good thing, right? Like if you care about the people who you love, the people you know, etc., this is a good thing to do. All right, that's part one. Part two is that you have this insurance component, okay? The investment component. Now, the investment component typically is creditor protected, meaning if you get sued, if you go bankrupt, if you go through divorce, typically that money is not available to someone, okay? So that money is protected. This is like, it has a benefit in and of itself, right? Like there's just, as like a rainy day fund, the difference is if you were sued, if you went bankrupt, etc., your stock portfolio is going away. This part is not, okay? So that's very good. Like, you kind of have to add like a certain value. What's the value of that? I don't know, is it 0.5% a year? Is it 1% a year? Is it, 0.1%? Is it 3%? Who knows, right? But there's something that's like, there's a value that you need to quantify in there. Number three, this is a collateralizable asset. Okay, what does that mean? That means that if you want to access that money, you can borrow against it and basically double use your money. I talked a little bit about that in the infinite banking video. You can check that out. Okay, great. What's the next thing? The next thing is that on top of it being a collateralizable asset, on top of these other things, you have another advantage, and that is that this is usually tax sheltered. Okay, so that means that in most cases, it depends on the part of the world, depends on your local rules, etc., but very, very often, all the growth is non-taxable. Okay, so let's compare this to you lend money out, you have to do a private investment deal. Okay, maybe you're going to put money into like a mortgage investment company, so you're lending money on mortgages. Let's say they're willing to pay you 8%. you're like, okay, well, but you're paying full tax on that 8%. So if you're in a 40% tax bracket, then the difference between 5% and untaxed and a fully taxed is it's a 9% difference. Basically, from 5.5 to 9 is the same return. Okay, so your after-tax return, which is what you should care about, right? Like you shouldn't care about what the headline number is. You should care, what do I actually keep at the end of the day? And what you actually keep at the end of the day is, the equivalent of 9% off of 5.5% because you're taxed favorably. And that doesn't account for the fact that, again, you have this death benefit. It doesn't account for the fact that you have this creditor protection. And in that case, you could leverage it. So, but there's some advantages where you can leverage it a little better when it comes to whole long-term participation. This is also an extremely safe asset. Okay, this is like probably the closest thing to a government bond in terms of safety. Okay, so even if you look at like when AIG went down, their life insurance division did not, right? So it's a very safe asset. You're talking like, if you consider there's essentially no volatility, right? And the downside is just very, very low. So again, if I compare it on a risk-weighted basis to, say, a mortgage, right? Investing out to that mortgage investment company, I could potentially lose all the money, right? If it's not properly structured. If it's structured through a limited partnership and they're not using it properly, et cetera, like there's a lot of risk there. Here, the risk is very close to zero. It's never zero, right? There's no such thing as zero risk, but extremely, extremely low. So that's very good for you, okay? What's next? The next is that average returns and actual returns are different. I may do a video on this in the future, but basically volatility undermines returns, okay? Let me show you an example of how that works. Let's say that you have $100,000 and year one, you make 50% return, okay? So, okay, great, you got 50% return, that's high, right? Then the next year you have 50% down. So you might say, okay, great, well I had 50% up, then 50% down, therefore my actual return is 0%, right? That's the average. Wrong. The actual return, because these compound, is negative 25%, right? You can just do the math, you can go, hey, 100 multiplied by 1.5 goes up to 150 times 0.5 is 75, okay? So what this shows is that, and I could break the numbers down for you. You can go and get a calculator. I couldn't believe this when I first saw it, but I'll give you a simple example. Let's say that you made 0% a year, over a 6-year period, you made, or it could be an 8-year period or a 10-year period, whatever. Every second year you made 10% and the other you made 0%. Okay, so you're still growing, but sometimes it's high, sometimes it's nothing. The average over those times, because the 0 and 10 cancel each other out, is 5% a year, right? Now compare that with just making 5% a year every year for those whatever time period, right? Let's say it's 8 years, 10 years. The return, the actual amount of money that you have at the end is better getting the 5% a year than it was getting 10, then 0, 10, then 0, 10. And it doesn't matter how you reorganize this. You could have 10 all, 4 in a row, and then 0, 4 in a row, or you could have 0, 4 in a row, 10. It doesn't matter. The bottom line is that volatility undermines returns, and volatility is nearly zero in these things. So that's a really cool thing, right? So why am I saying this? I'm saying this because both for ensuring banking stability, as well as in terms of having like some sort of a backup, safety net, etc., permanent insurance is a nice thing. It happens to have this other advantage, which is in some cases, and there's lots of technicalities about how this works. You can dive into it and make sure it fits with your country and how the country's rules work, etc. But sometimes what can happen is that you can end up in a situation where you can borrow money out. Basically, you end up with an insurance policy which can be borrowed against, and you can access money and be able to use it without needing to pull it out and pay the taxes associated. Eventually, the insurance policy will get paid out and taxes will get paid and all that kind of stuff. But you can essentially defer the tax for a long period of time and avoid the personal tax by having this borrowed money, and that's pretty useful. So that's its whole own strategy, and you need to, again, like I said, it varies country to country and how it works, and how the policies are structured, and so it's complex. So I'm not going to get into it today. But the bottom line is that it can be a really effective tax strategy, in addition to being a reasonable investment in terms of providing asset protection, in terms of assisting you with having a better relationship with your bank, et cetera, et cetera. So anyway, I hope that helps. I hope that gives like a little bit of explanation. You just need to understand that there's an investment component that goes along with the temporary component, and that makes it a permanent policy. So what's happening is that over time, the value of this, the money you're putting in, is growing the size of the policy. That's why it's permanent, right? Every time you make a monthly payment, a little bit of it pays this premium, but the rest is adding up to this investment fund, adding up, adding up, adding up. The fees are actually front-end loaded, so you end up paying more of them on the front, and so it takes some time before the amount of money that you put in adds up to what you actually have access to. But the bottom line is that you're building an asset. It's like you're building an investment, and that investment is wrapped in asset protection, it's wrapped in tax advantages, it is very stable, it is very safe, and it gives you a death benefit and some other things. So it's pretty good. I wouldn't like put a huge portion of your wealth in there. Some people are like, oh, you know, you should put 100% of your wealth, and then you're gonna pull the money out and you're gonna put it into some other thing. It's like, no, don't do that. But you know, say 5% of your wealth going into there, I think is a very reasonable thing. So anyway, hope that helps. If you liked the video, click the like button, click the subscribe button, click the notification bell. If you have questions or comments, put them in the link, the comment section below. Would love to hear from you. Share it with your friends, please. You know, I'm trying to get out some good information to people. If you would like some assistance with, you know, again, tax planning, asset protection, you know, some of this stuff to do with investing, banking, residencies, citizenships, etc., you can book a call with me, clarity.fm/Michael Rosmer, or there's links below. Also for offshorecitizen.net, offshorecapitalist.com. I'm going to see you guys on the next video.